Welcome to Epistemology.
You know what I like a lot more than materialistic things? Knowledge. What is this?
It's a podcast.
Hi guys, great to have you back for another episode of Epistemology. And if you're new to the show, welcome. This show is about platforming early career researchers so they can share with you their research passions and insights from the frontiers of scientific discovery. I'm your regular host, Dr. Mark Fabian, Deputy Director of the Institute for Social Change at the University of Tasmania and an affiliate fellow at Cambridge University's Bennett Institute for Public Policy. This episode is all about macroeconomics. Economists will often commiserate with each other about how whenever a family member or a random stranger discovers that they're an economist, they'll immediately ask for stock market advice. What shares should I buy? Is now a good time to get into gold? But economics has very little to do with the stock market. In fact, it has so little to do with the stock market that macroeconomics, which does study finance, is often its own little kingdom within economics faculties. I confess that I too, despite my PhD in economics, know very little about what's going on in macro land. Fortunately, I've got guests that I can ask for an informed perspective. This episode, we've got Dr. Adam Triggs to enlighten us about the big issues in macro. Adam has a very long signature block. He's director at the Canberra office of Alpha Beta, an economic consulting firm within Accenture Strategy, non-resident fellow at the Brookings Institution in Washington, D.C., a visiting fellow at the Crawford School of Public Policy in the Australian National University, a fellow at Macquarie University's E61 Institute, and a columnist for the Canberra Times. All these hotshot agencies want Adam's insights, and he's giving them away to you for free right here on Epistemology. Adam explains how Western powers are trying to create a financial crisis in Russia, how we should plan our lives around the present bout of inflation, what exactly the puzzle is in productivity, and how macroeconomics has reformed its models and methodologies in the wake of the global financial crisis. Stay tuned for these bombs and more.
Epistemology.
Okay, welcome Adam Triggs to Epistemology. Thanks for coming on the show.
Thank you. Thanks for having me.
So tell us a little bit about your research.
So my research really stretches across sort of three main areas, which would be finance, macro, and competition policy. When it comes to finance, so most of my focus has been around, so how do you prevent financial crises from occurring? And then how do you stop them from spreading from one country to the next? And it's sort of weird at the moment with Russia, because normally the focus has been, what can we learn from past financial crises? And how do we stop them from occurring? Whereas at the moment, a lot of the work that I'm doing and a lot of the public commentary at the moment is how can we start a financial crisis? So we're actually trying to trigger a financial crisis in Russia, either through their banking system or their currency or whatever it might have been. So it's a little bit weird to suddenly be on the reverse side of that. But anyway, that's, keeping me entertained. In terms of macro, my focus is related to that, has always been on spillovers between countries. Mm-hmm. So when you have a change in fiscal policy, a change in monetary policy, which is what we're seeing at the moment, or a change in sort of structural reform around productivity, what are the spillovers between countries and what's the case for cooperation in light of those spillovers? And then competition, just randomly, because I used to work for Australia's competition regulator. Focus there is, what's the state of competition in Australia? What role does it play in these challenges that we had pre-COVID, around low wage growth, low employment, low rates of investment, secular stagnation, lack of innovation, all of these sorts of issues. Is competition because of these? Is that playing some role? And certainly after COVID, I think it's going to pop up again. So a bit of a random mix, but those are the main three that I tend to focus on.
Yeah, really great stuff. So definitely we'll engage with all of those throughout the show. I was hoping to draw your opinion on kind of the big topics in macro at the moment, like inflation and secular stagnation, which you mentioned. But maybe before that, we could spend a little bit of time on Ukraine, because that's obviously super hot, and it does sound like quite an interesting subject, how you start financial crises. So can you just elaborate a bit more on kind of what foreign powers are trying to do there?
So, I mean, essentially, they're trying to punish Russia, or they're trying to get Russia to stop the invasion, although most people accept, including the President of the United States, accept that really what we're trying to do is it's around punishment, it's around deterrence in terms of what other countries might do in this space. So I think really what they are trying to do here is to trigger a crisis within Russia in order to create that domestic pressure on Putin, particularly given there's such little domestic support within Russia for this conflict. So they're really trying to sort of inflame that, seems to be the motivation. And they're doing that through essentially, in my view, trying to create a crisis either in their banking system or through their currency, or trying to create a crisis through the other form of financial crisis, which is a default. So that is a default by the government. Yeah.
Okay. And do you think that they'll be successful in these efforts?
So it's all a bit negative, but I think if you're trying to create a financial crisis, it's a bit like trying to burn down someone's house. The first thing you're going to do is you get rid of the fire extinguishers, obviously. Then you throw around some fuel, and then you need to have a lot of sparks. And I think that's their strategy. So the fire extinguishers in particular, they're removing their foreign exchange reserves. So as everyone tries to withdraw cash out of the economy, their exchange rate collapses, meaning that all of the debt that they have that's denominated in a foreign currency suddenly blows up and it becomes really big. So I think that's the primary goal there, is to stop them from using their foreign exchange reserves to stop that process from happening, to stop the ruble from collapsing. It dropped about 20% the other day. And I think that's going to be quite an effective strategy. The thing that I think they're not getting right is that you do actually want people to be able to take their money out of Russia. If you want to cause a currency crisis, you need people to sell rubles, which means they need to take their assets out. And they're actually stopping a lot of the oligarchs and everyone else from doing that by preventing people from getting their money out of Russia. And I think that's probably a mistake. If their goal is to create that financial pressure domestically, you would actually want as many people doing that as possible. But overall, I think you probably will see a default from Russia, first time in 20 years or whatever it is. And you will probably see some kind of financial crisis popping up, probably in their banking system. So,
Okay, right. One thing I wanted to get your perspective on is I had read that Ursula von der Leyen, or whatever her name is, the head of the European Commission, had announced that they were going to try to freeze Russia's central bank activities. I'm just kind of wondering, like, what does that mean? What is the mechanism by which they do that? And what is the kind of legality of that sort of behavior?
Yeah, so the analogy, I think, is to think of like Indonesia during COVID-19. So what they did, because they have a lot of foreign debt, which means that if, like I said before, if their currency drops, that debt gets bigger, and then eventually could lead to a crisis where investors lose confidence in their ability to repay. The way they defend that is using their foreign exchange reserves. So they basically use the big sort of stockpiles of foreign currencies they have to then buy their own currency to push the value back up. Or they potentially can issue debt internationally. So they can actually issue bonds denominated in US dollars to draw in more foreign exchange reserves. And that's what Europe is, and that's what Indonesia did during COVID. And that's what Europe is stopping the central bank in Russia from doing, is they're stopping them from accessing their own foreign exchange reserves, because a lot of it's invested in assets overseas, so they can freeze those assets. But then also preventing them from issuing debt and selling other assets in order to raise more foreign exchange. And then they also use the SWIFT banking system as well. So they're blocking that, and that's preventing a lot of that transmission mechanism through monetary policy through the banks. So they're trying to hit them from all sides, really. So it's in terms of the legality of that, well, it's within the European Charter. I'd imagine they'd be adhering to that, but see how they go.
Okay. And so how do you prevent them from issuing debt? Like, isn't that the sovereign central bank of Russia's prerogative? So they issue it on their own markets, don't they? Or is it necessary for them to access European markets in order to issue debt?
So essentially what they're doing here is borrowing money from overseas. And what Europe does is prevents anyone from lending money to them through that transaction. And then also shutting down the SWIFT system to stop the transaction itself. So that's the primary way I think they're playing that one out.
Okay, right. And so one final question maybe on this one is, you mentioned before that maybe they should actually be a little bit more lenient on oligarchs trying to rescue their assets. Is there any way to do these macroeconomic attacks on Russia in a way that punishes mostly those close to regime rather than sort of everyday mums and dads at home?
Yeah, so I think what you need to do is allow assets within Russia to be shifted out. And that's because that involves dumping rubles, which then causes the currency crisis. But you can then make sure that you control those assets once they're out of the country, because those assets will land somewhere. And if they're landing in the US or Europe or anywhere else that they have some jurisdiction over, then that's when you can sort of clamp down on the assets. So that would be the best way of both allowing the currency to be tanked while also potentially still clamping down on those assets and causing that pain for a lot of these oligarchs. But it has to be said, a lot of these oligarchs, their assets are already out of Russia. They moved them out a long time ago because they could see the writing on the wall on some of this. But certainly stopping your average Russian from getting their money out, I don't think that really makes that much sense.
Yeah, right. Okay, cool. Well, thanks very much, Adam. That was super helpful insights into this interesting kind of new style of warfare, I guess, because I don't think there's been too much of this sort of thing previously. Is that right? Has kind of macroeconomic assaults been part of previous wars at all?
Well, I don't know about sort of the long history, but certainly since World War II, we haven't seen this sort of thing. There's been a lot of discussion about this in terms of potential conflict with China and the US because they are such, a large debtor-creditor relationship between the two of them. I don't think it's ever really played out to this scale with an economy the size of Russia's. But yeah, so it's one of these beautiful natural experiments which macroeconomists very rarely get.
Yeah.
So we can watch and see what happens when you do this sort of stuff. So
okay, cool. All right, well, let's move from the Russian crisis over to inflation, which was the crisis du jour, a month ago, and still very much going on. So maybe I start with this general question, why is inflation bad? Why has it become such a major theme of macroeconomic policy? Why do we target inflation instead of unemployment?
Yeah, so I think people are right to be confused because before COVID, inflation was really good, right? Everyone wanted more inflation, and now suddenly we desperately want less of it. So I think it's fair that people should be confused. The analogy I normally use is to think of inflation a bit like water. So if you have too much water, you drown, you die. If you have too little water, you dehydrate and you die. So it's basically a question of balance. You need to get the right amount of inflation. If you have too much inflation, that means prices are constantly rising. It means no one's going to consume anything because the prices are so unstable. You're certainly not going to invest. No one's going to invest in the economy if you can't have any predictable prices in order to factor that into what your return's going to be. And if you get deflation when prices are going backwards, no one will consume because you're never going to buy something today if it's going to be cheaper tomorrow. And you get the same problems on the investment side, that if you have huge price instability, no one's going to want to invest in your economy. So you need to get that balance right, essentially, between the two of them. And in terms of why we target inflation, part of this is historical in the sense that the frameworks that were developed were around the time, or very close to, for most countries, the huge takeoff in inflation we had in the 1970s. So inflation was a huge issue then. And then that was one of the reasons it was baked into the mandates of central banks. Most of them do have full employment, or a lot of them do have an employment aspect to it as well, where they are expected to keep inflation within a band or around 2%, but then they're also meant to strive to achieve full employment. The issue, of course, is there tends to be that trade-off between the two of them. And this is that concept of NARU, the non-accelerating inflation rate of unemployment, which is basically just the idea that unemployment and inflation tend to be on a bit of a seesaw. So when the economy is going really strong, like it is in the US at the moment, you tend to get a lot of inflation and you tend to get low unemployment. But then when the economy is weak, you tend to get low inflation and high unemployment. So one of the reasons they tend to target inflation is because they see that as being the sort of the one side of that seesaw, and therefore you can just focus on that one sort of metric. But there's lots of questions about whether that's still relevant today, given that before COVID at least, inflation was really low.
Okay, great. So let's talk about Nauru for a little bit then. So why is this 2 to 3% inflation per annum band the kind of target of most central banks? Why does that hit the sweet spot?
I think to a large extent it was sort of made up. So it's not correct to say that there is some, that there's this econometrics out there that has produced this number. The idea is that if you get too low, then it can very easily dip into deflation, because we know that inflation from one quarter to the next will change. So if you're too low, then you can risk getting that deflation accidentally occurring. If you're too high, then prices can run away too easily. So I don't think there was any real science behind picking 2%, but it's seen as being somewhere around that sort of balance, essentially.
Okay, right. Cool. All right. So let's move then to contemporary inflation. So you mentioned that prior to COVID, we had this trend of kind of secular stagnation, which goes beyond deflation, but definitely deflationary pressures were a big part of it, seem to be substantially coming out of elderly populations in a lot of cases, but also out of a range of other issues. And then now under COVID, particularly in the US, but in a lot of developed countries, there seems to be massive inflationary pressures. So what's behind that change? What's been driving that?
Yeah, so it's pretty tricky. So certainly before COVID, most people would point to these big structural factors which were driving low inflation and low interest rates. You touched on one of them, which is an aging population, because older people tend to save more. And if they're saving a lot, that means that interest rates are going to be lower because you have that much larger pool of savings that's at disposal. The other related one is around inequality. People point to the fact that poorer people are more likely to spend their income because they have unsatisfied consumption needs, whereas richer people tend to save. So if you have more inequality over time, then that's going to mean a lower inflation, lower interest rate environment as well. Competition, which is close to my heart, is put forward as another potential reason that if you have a lack of sort of innovation in the economy, and you don't have a big demand on savings, then that means you get lower interest rates as a consequence of that as well. And then there's some other structural factors around like global integration. So when you bring, this is Ben Bernanke, we talked about a savings glut coming from China. If you have a country like China, although these days it's actually Germany and the Netherlands, these countries who have enormous pools of savings who come into the global economy, you get all those savings slosh into the rest of the global financial system, which then pushes down interest rates, and it results in, particularly with China as well, exporting at lower cost means lower prices. So you get sort of lower inflation coming from that as well. So, I mean, that was the broad story before COVID. I think when COVID hit, at the end of the day, inflation is about prices rising in the economy. So it occurs because you get demand for goods and services outstripping supply. So what essentially is happening at the moment is we're getting hit from both sides. So demand is really high and supply is being contracted. So when we think of demand, we know that people saved enormous amounts of money during COVID. They're now spending that money on going out and spending it. So there's a big increase in demand, but they're also not spending it the same way that they used to, which means that they used to spend money on services and restaurants and things like that. But because you don't want to get engage in services where you have a lot of personal contact because of the pandemic, they're shifting all that spending onto goods. So you've got this big increase in demand for goods anyway. And then you've got more, all the services demand is on goods as well. So you've got this double whammy of demand that's going off. And then you've got all these supply problems in terms of supply chains, all the challenges we've seen there, but also rising oil prices feeding into the input costs of businesses. You've got workforces who are not available because they've either been sick or they've been furloughed, which again drives up costs. So it's not really surprising we've got this big increase in inflation at the moment. the sort of question is how long it lasts and whether we go back to that longer term trend of low inflation and sort of low interest rates.
Okay, great. Well, just before we get on to that question, I wanted to backtrack a little bit to this point you made about how we've had a glut of savings for a long time. So China coming onto the world economy was a big part of that because they have these savings rates in like 30%. One question I had in that regard is that for a long time, central banks have been trying to increase inflation through monetary policy, like having really low interest rates. But it seems like one thing that's happened with those very low interest rates is that asset values have been generally increasing a lot. If I understand correctly, that's in part because the system is so awash in liquidity that investors will just invest money in stuff that actually is not a particularly good bet long term. I remember people saying that Boral, which is a concrete company in Australia, managed to raise huge amounts of capital to stave off bankruptcy recently at something like 3% interest, even though that was just like a terrible bet. But there's just so much liquidity. So how does that that monetary policy factor into these issues? So savings is something where you're chasing returns, right? So high asset values seem like something that would be helpful. But if the low interest rates are just making it more attractive to invest, don't they kind of compound the problem?
Yeah, well, it's really tricky because most central banks, including in Australia, the sort of mandate includes sort of full employment, it includes inflation, but also includes financial stability. And that's this sort of really big trade-off that you have, that when you stimulate the economy by reducing interest rates in order to make it cheaper for people to finance their mortgages and essentially put more cash in people's pockets to spend. The risk then is that when you get those that big sloshing around of liquidity, you get those asset prices, like housing in particular, start going up significantly, as we've seen around the world. So there is that challenge of trying to basically manage those two things at the same time. And really what most central banks have fallen on is to say that you adjust your monetary policy and interest rates for the level of demand you want in the economy, and then you try and control financial stability by targeting those particular assets. So this is what's called, macroprudential policies, where regulators will make it harder for people to borrow money to buy a house. So they'll change how much you have to have as a deposit, for example, or they'll constrain the amount of lending that banks can do for housing by changing the rules around what sort of buffers they have to hold and things like that. So that tends to be the way they sort of balance those two things out.
Okay, that's quite interesting. Let me draw you on one more question in this regard, which is about those structural factors that you mentioned. So this again seems to be one of these kind of tricky areas, I suppose, where if you have these low interest rates and you're pumping liquidity into the system with an eye to try to get inflation up and try to get unemployment down, one thing that you're going to be doing is increasing inequality, as you mentioned, because the people that benefit from these low rates are the people that can borrow easily, like all the people investing in real estate in Australia. And the other thing you're going to do is potentially affect productivity and market concentration, right? Because as I mentioned, Boral gets bailed out, even though really Boral should be allowed to collapse. So is that just another kind of complicating factor for central banks? And then I'll have a follow-up question, but I'll start with that. Yeah.
Well, it definitely is. And in many ways, this is where you sort of bring in the short-term, long-term consequences of these things. I mean, your point is that if you monetary policy, when it's really relaxed and interest rates go down, the concern there is you inflame inequality. And we know that inequality is also a driver of this long-term challenge we've had of sort of low inflation, low interest rates, which is pre-COVID, of course. And I think that's definitely true. And researchers have pointed that out, that we do have this mismatch between the two of them. And they would argue that the solution to this is to, given that monetary policy is about balancing demand against supply, essentially, in the short run, you need really governments to take the action in terms of reform to address those long run challenges. So Relying on central banks to solve inequality is a really bad idea. We should be relying on tax reform and welfare reform and productivity reform in order to do that. So it's really, in many ways, the research would point the finger at governments for failing to address these issues, and monetary policy therefore just keeps on bouncing the seesaw back and forth without actually sort of addressing any of those core problems.
Okay, wonderful, because that was basically my follow-up question is, what is the kind of role for a macroeconomic reform in this context of fiscal policy? Because it seems to me like the last 10 years at least, if not longer, have seen a period in the US, the UK, and Australia of very minimal substantial reform, despite there being a lot of obvious candidates for major reforms. So you mentioned the big ones in Australia already: market concentration, tax policy, climate policy. Yeah, so is there a concern at all that in having central banks doing, I would say, a very good job of macroeconomic stability and a very good job of kind of keeping the ship sailing straight, that actually takes away some of the urgency and crisis pressure from governments to actually do these big reforms?
Yeah, big time. And this is what makes, the independence of these central banks so difficult, that they're politically independent, which the research shows us is a really good idea, because that's one of the ways you control stability and inflation and everything else. But it makes their life really difficult when they are essentially providing an anesthetic to the economy. So when you have governments that aren't undertaking those productivity enhancing reforms, which is fundamentally what will drive long run growth, the Reserve Bank then has to respond, or whatever central bank has to respond, by then loosening monetary policy and giving the economy a sugar hit, which is completely unsustainable and doesn't, not only does it not address that core structural problem that government should be solving, but it also in many ways distracts them or buys them more time. And this was the key problem coming out of, say, the global financial crisis, where central bank governors said until they were blue in the face that all we're doing to you at the moment is buying you time to undertake reform, to fix up your budget and do everything else. And unfortunately, they didn't do that, and we had this sort of decade of pretty anemic growth, and now we've had a huge crisis, and now we've got even more debt, and it's sort of cycling around.
Okay, that's a bit concerning. All right, so returning to sort of the contemporary COVID inflation period, before I ask you what we should do about it, I guess one trope that's come up in the popular culture commentary a lot is that a lot of this inflation is kind of fake, and it's actually just driven by corporate greed. Like they've seen an opportunity to jack the prices. I saw one example of this that seemed pretty stark, which was that Starbucks was increasing its prices but not increasing its wages, and was increasing salaries for the board and the executive class. And I know that Biden and Warren have both been banging this drum a little bit. So is there anything to this corporate greed claim, or is this just rhetoric?
So I love competition policy, and I always get accused of, whatever the problem is, I blame competition for it. But certainly in this case, blaming the current increase in inflation on competition, I just think is baseless.
Right.
So the argument around corporate greed is that there's not enough competition, and you've got monopolists who can price gouge and jack up prices, and that's what's sort of driving this inflation story. I think this is politics, simply because Biden, in many ways quite correctly, went into the election saying that we have a competition problem in America and we need to fix this. I think that's definitely correct. But linking that to inflation, I just don't think that stacks up to any evidence. I mean, first of all, competition is a very slow burn. So the competition problems that have been happening in America have been happening over a very long time. The idea that there's suddenly been a big worsening in competition that would drive 7+ percentage points worth of inflation within a particular quarter just doesn't stack up. It's very hard to make that claim. And when we look at the causes of weak competition, it is that long run story around mergers and acquisitions. It's sort of around market concentration. It's not around issues that could possibly explain a really big sharp increase in prices. And some of the things that they talk about in terms of breaking up businesses and things like that would almost certainly increase prices further. It's not to say if you think that's a good idea or not, but the short-term effect would certainly be to have more inflation, not less. So some of their policy prescriptions are pretty bad ones as well.
Right. Okay. Well, so on that front, how do you see this area playing out over the next, say, 2 years? Like what policy changes would be good? How should people at home kind of think about their finances and think about expectations over the next 2 years?
Yeah, so I mean, we talked about like all of the things that are driving the current bout of inflation, and a lot of those things are probably temporary. So when you think of the big increase in demand for goods and services, people will, run out of money at some point. They've saved up a lot, but at some point they will sort of hit the bottom of their wallets on that. You've also got, people will start going to restaurants again. They'll start buying services again. That'll calm some of that demand on goods. A lot of the indicators around supply chain suggest that some of the challenges we've had there are starting to turn and they're starting to calm down a little bit. Same around workforces. We're seeing people getting back to work. We're seeing that sort of the Omicron strain sort of passing. So there's a lot of reason to think that inflation is temporary, and that would be sort of my take for Australia. For the United States, it's a bit tricky because some of the inflation has come from a really big increase in spending by Biden, which both puts money in people's pockets to go out and buy stuff, but also they're buying stuff directly as the government. And a lot of that is multi-year. So a lot of the spending that he's proposing is over several years. So I think there's reason to think that in the US, particularly because they had a bigger increase in inflation as well, that it might be a bit more permanent for them. And then everyone is really just watching wages, because once wage bargainers start to expect higher wages, because inflation is fundamentally about what people think is going to happen next. If they think that inflation is going to stay high, then they'll start baking that into wages. And once they bake that into wages, that potentially gives another bump to demand, and you start to get a bit of a cycle going. And then that's potentially what kicks off some more permanent inflation. So everyone, most of the central banks, are very nervously watching what happens to wages in terms of what they think the long run effect is probably going to be.
Yeah, right. Can I just draw you on a short further commentary on that then? So I know that in Australia, one of the reasons why the central bank has kept interest rates low for a long time is that it hasn't seen wage growth. And that's the main type of inflation that it wants. And I think similarly in the US, you've had decades now in which labor's bargaining power has been shot. And so you haven't got much wage growth in the US either. And US labor seems to have kind of woken up under COVID somehow, like finally realized that bosses are just absolutely trashing them. And they don't have a lot of legal recourse often in America. So do you think, again, it seems like a delicate balancing act where maybe you don't want a wage price spiral, but at the same time, you do want wages to go up. So how do you think central banks should navigate those challenges?
Yeah, so they will wait to see if wages go up, and they will welcome an increase in wages, given that this has been the goal for policymakers for some time. But yeah, you certainly would want to avoid that wage price spiral. So they'll be watching it very closely in the sense that they'd be happy to see some increase, but they're not going to want to see sort of a runaway sort of spiral start to emerge. And it's important to keep in mind here as well, the only thing that really benefits households is real wage increases. So it's one thing to say that your nominal wage has gone up, 2%. If prices have gone up 7%, well, you've actually lost money. So that's the other challenge here, is that currently, without a wage increase, we've actually have got people who are losing money in real terms. So certainly in Australia, but certainly in the US, they're seeing real wages falling. The purchasing power of their money is declining. So there is a balancing act, not just in terms of avoiding an inflationary spiral, but it's also just compensating households for the fact that stuff is a lot more expensive at the moment. Right.
Is wage growth another one of these areas where it's mostly kind of microeconomic structural factors? I don't know the Australian situation that well on this, but in the US, it does seem like so-called right to work laws and the general kind of prohibitions on unionizing and any kind of industrial bargaining really in the US. I would think that is a big part of why you don't get wage growth long term.
Yeah, exactly. I think it is. It's the micro story around. I mean, at the end of the day, wages are a function of the demand and the supply of labor.
Mm-hmm.
And what we're really seeing here is a bunch of micro foundation issues that are constraining the demand for labor from businesses.
Mm-hmm.
Part of that might be a competition story. Part of it's, a change in sort of transitioning of businesses. It's also a productivity story that you've got some firms which are really, really productive, these frontier superstar firms, and then lots of these family businesses that aren't productive at all. And as a consequence, lower productivity, and you get lower sort of wages as a consequence of that as well. So I think you're right. Yeah.
Okay, well, that's a nice segue to our next big issue in macro, which is productivity. So a lot of macroeconomists have been talking about the productivity puzzle in recent years. I know my boss at Cambridge, Diane Coyle, is spending a lot of her time on this issue. So before we get into what the productivity puzzle is, could you just tell the audience a little bit, please, like what is productivity?
Yeah, so at the end of the day, productivity is just about doing more with less. So it's businesses being able to produce more output using fewer inputs. So the inputs we normally categorize in economics are sort of capital and labor. So we usually measure fairly imperfectly, measure productivity as being a residual, which is a fancy way of saying if a business has produced more output, we look to see, have you hired more workers or have you purchased more capital, more equipment and factories? If the answer is no, then we would assume, therefore, that must have been productivity. You figured out a way of being able to produce more with fewer inputs. And often that's about technology in particular, but it's also about things like business processes and having more efficient management processes and things like that.
Yeah, great. And so what is the productivity puzzle then?
Well, the puzzle is we don't have any of it. It's the main thing. Well, the puzzle is that we've, over certainly the last sort of 10, almost 20 years, productivity has been very low, despite the fact that we've had enormous advances in technology. And normally, when we get a big increase in technology, we expect to see productivity increase. So we've seen social media, we've seen advances in ICT, we've seen artificial intelligence, we've seen massive changes in terms of, if you go back far enough, the internet and everything else. And we haven't seen productivity go up. So we've got this sort of paradox as to why this is occurring. And there's a whole bunch of theories in terms of what's going on. The most optimistic theory is sort of the William Nordhaus argument, who won the Nobel Prize in 2018, I think it was. And he argues that it's all good. Productivity is going to go up pretty soon. So he argues it's just a lagged effect. And there's an analysis from Bell Labs which shows that when you do get a new technology, it takes a certain amount of time for it to be adopted by enough people. And then after that, it starts to boost productivity. So they predict that productivity will probably start going up the end of the end of the 2020s. So like 2029 around then. That's pretty optimistic. The sort of pessimistic view is like Robert Gordon at Northwestern University, where he argues that social media is really great and everything, but it's not quite as good as electricity. So his point is that the sort of productivity boost you get from the combustion engine and electricity is nothing like what you're going to get from people being able to use their phones while they're on the toilet, right? In many ways, another argument is that a lot of the inventions that we've had and the technology advances have improved leisure. They've made leisure better. So Netflix and your phone and things like that, they haven't made us more productive at work. In fact, some people argue that they've made us less productive, and maybe mobile phones that we touch, on an average of 150 times a day or whatever it is, that maybe they're reducing productivity. And then the other theory is that it's, and there's a lot of evidence to support this, is that it's sort of a firm level thing. So you have these superstar firms like Google and Facebook, which are really, really productive. And then you've got these laggard firms like the family-owned businesses that aren't productive at all. And they're sort of cancelling each other out. So you do actually have a lot of productivity, but it's being cancelled out by like less productive firms. So this is the debate that's currently happening, is in terms of why it is that productivity is so low despite these advances.
Is there not a fourth issue here, which is that maybe we're just not measuring productivity well? So my understanding is that this comes out of the fact that a lot of places are transitioning to heavily service sector dominated economies, where it's pretty easy to look at the wage bill of a service sector organization, but it's not so easy to measure their outputs. And it's not so easy to measure the capital that they use. And productivity in service sector firms just intuitively is kind of a weird thing, because you have so many meetings. It's just kind of very difficult to coordinate service sector work across multiple parties. And so you have a lot more of these kind of like dead activities where you're not sure whether that meeting was in fact necessary to the operation or not. So how do we measure productivity, and is that part of the puzzle?
Yeah, I think it is. This is sort of the Martin Feldstein argument, which is that we're just really bad at measuring things like quality. So if you think, we had mobile phones, 10 years ago, but they were really crap. Whereas today they can do really cool things. How do you measure that? And the answer from macroeconomists is really badly. We basically measure it in terms of the value of the phone. And, the phone 10 years ago, which cost $600, $600 gets you a really good phone today. And we don't pick up that quality aspect. We don't pick up all the things that don't have a price. So things like Google and all of these other inventions and services that have undoubtedly made us, more productive in many ways. How do we measure them if we don't have a price on them? Again, they don't get picked up. So that's definitely part of the story as well, is that lack of our ability to measure it. And as I said before, that we treat productivity as a residual. So if a firm produces more output, even though they didn't use any more input of capital or labor, we just assume that was productivity. Whereas there could be other factors driving that as well. So we're pretty crap at measuring this stuff as well.
Okay, right. In what ways could we measure them better? Do you have any thoughts on that?
There's a lot of researchers who are looking at this, and they are trying to put values on some of these things, for example. So one of the classic ways is, what economists distinguish between revealed and stated preferences. And we actually will ask people, how much would you pay for Google if you had to pay for it? And ideally trying to come up with some natural experiments to figure out how much it's worth to people, and then punching that into the national accounts figures, and then using that to add some value that comes from that. But there is research that's trying to look at the quality of these things as well, and trying to break down exactly how much better, or what are the advances that we've had from some of these technologies. But we certainly haven't come up with a clean answer. We haven't come up with taxonomies that everyone can agree to either, which is key for those international comparisons. So it's still a way off, some of this research.
Before I ask you kind of what's your take on the productivity puzzle, what do you think is going on? Could I ask you maybe first, like, what are the consequences of the productivity puzzle for macroeconomic policy making in particular, and that sort of thing? Like, are we just making a lot of bad decisions at the moment because we don't kind of have a lot of confidence in our measurement in these issues, for example?
Yeah, so the consequences are huge. Long run growth in living standards comes from productivity. It doesn't come from capital accumulation. It doesn't come from population or any of these other variables. So the long run consequences, I think, are enormous here. And what does it mean for policy? Fundamentally, it means that governments need to figure out ways of raising productivity, and that's through structural reform. Monetary policy won't do anything. Fiscal policy, to a large extent, is just shuffling demand around from the past to the present, or the future to the present, other than things like infrastructure, which will have that sort of productivity benefit. So it means it has to come from reform. So it means reforming your tax system, boosting competition, reforming your welfare system, having more trade, more foreign investment, the things that we know for certain do boost productivity, having more of those things. The concern, though, is where not only are we not seeing the reforms that we need, but in many ways we're seeing backward steps on some of the things that we know for a fact are very good for productivity. So trade, foreign investment are two of the very big ones. We know that governments around the world are clamping down on those, which is a really bad idea. But then again, monetary policy and fiscal policies being too much of an anesthetic, and it's distracting us from having those big reforms implemented. Whereas certainly during COVID, when governments were spending like drunken sailors, that's the time to do reform. That's the political sweet spot. When everyone's got a bit of cash in their pockets and they're feeling okay, that's the time to undertake reforms where there's going to be winners and losers, and then making sure you compensate those losers as well, which is something else that we've been pretty crap at in Australia, but certainly in the US as well, compensating people who will lose from big reforms.
Right. Okay. I mean, historically, I think we were really good at that. Like the last big round of reforms in the 80s and stuff. It's just more recently where we've been dropping the ball a bit. Okay, so what is going on then with productivity? So I know you've written papers on this, as I understand it. So what's your take? And could you talk us through your kind of analytical process to arrive at it?
Yeah, so I mean, I think that you will see some of it is a lagged effect, and I think you will see some of an increase that will come through there. But I do tend to agree, certainly when you look at the research which compares the productivity or the likely productivity effects of recent advances compared to those of the past, I don't think you're going to get that as bigger effect. So I think in many ways, what we're seeing here is, certainly for Australia, is we're sort of just running down the capital of past reforms. And the way to solve that is to undertake a fresh wave of reforms in order to raise productivity. So I suppose I'm a bit skeptical in that sense. In terms of sort of how you measure productivity, I think we can take some baseline where we can say there's probably a little bit more productivity in the system than what we're seeing. But at the end of the day, measurements are one thing. We know that what flows from productivity are things like higher wages, for example, and we know that we're not seeing that. So I think that gives us some indication that actually having a lot of confidence that we're mismeasuring this as actually this big well of productivity that is happening, I think is probably not borne out by the evidence. So I'm a bit pessimistic in that regard, that I think we're probably not going to see a huge increase, and we need to sort of work off the assumption that this is as good as it gets, and we need to start sort of fixing this problem. Yeah,
doing the hard micro work.
Yeah, pretty much.
Yeah, I always think, like, this is a bit of a tangent, but I always find the hard micro work to be the most kind of interesting part of economics in a way, because it's so kind of systems based. You have to think about how all the bits fit together. And it's kind of sad to me that so much of my discussions with contemporary young microeconomists is just always about applied, and causal inference of some small thing. And I'm like, you can't causal inference systematic reform of the tax system. Like there's 127 taxes or whatever in the Australian system, which is actually, and then all the other exceptions and tax minimizations and loopholes and whatever. If someone was to develop like an overall plan for how to fix that, you're not going to be able to kind of come at it in a natural experimental sort of way. But it seems to me like that sort of work has much more potential to improve humanity's lot than some kind of tightly executed RCT on one particular tax.
Yeah, I think you're right. I mean, I think unfortunately you get a bit of a division where you get people who are really on the micro, so very focused on small issues, and then you get people who are just really big macro and just very sloppy on the details. And I think you see some of that certainly in Australia when you look at, say, big increases in fiscal stimulus during COVID. There wasn't much of a micro foundation for any of that. A lot of the sort of the focus was on how much money can we get out the door as fast as possible, rather than saying, what are we using this money for? Where is it going? You know, what is this going to do to sort of shift incentives to improve long-term growth? So yeah, I think it's pretty tricky. You get that, you do get a bit of a shift where you have the people who scorn macroeconomists for being too sloppy and too high level, but then they get so purist into these small issues that when it comes to a huge crisis, they've got very little to add because they've spent the past 10 years focusing on such a minute issue. You need to reform a whole system. How do you do that? And there's no value to add there. So yeah, it's pretty tricky.
Right. Okay, cool. Well, let's move into the last topic that I wanted to get your perspectives on, which is, I guess, more of an academic issue around how we sort of do macroeconomic modeling and how we do macroeconomic theorizing. So I think you've mentioned this a few times already in the podcast. It's notoriously difficult for macro to do things scientifically because it doesn't really have access to experimental methods. We can't give one country a financial crisis and find an identical country that we don't give a financial crisis to and then look at the difference. So we're always kind of chasing things around, and macroeconomies are very, very complex adaptive systems. So they're quite hard to develop kind of neat formal models for, like we have in micro. My understanding is that recently there's been this debate within macroeconomics, at least within the memeing community, between like micro-founded macroeconomics, which the name seems to me to be a misnomer because it's not really about like general equilibrium modeling or something from microeconomics. It's about kind of using rational choice theory to model the macroeconomy as like a single agent, but I'll get your more educated perspective on this in a moment. So micro-founded macroeconomics versus dynamic stochastic general equilibrium modeling, which is much more of a kind of data-driven approach. So could you just enlighten us, please, on what these things are? Is this actually a debate, or like how is this kind of playing out in macro?
Yeah, I think it is a debate. So, I mean, a dynamic stochastic general equilibrium model, or just DSGE, which is a hell of a lot easier. Essentially, I mean, when you talk about a general equilibrium model, you're talking about a closed system. So in that sense, within that system, when you have resources move from one part of the economy to the other, there's a trade-off effect, which happens elsewhere. So it's closed in the sense that it can't, for an example, an economy sort of can't have a budget that grows forever and ever and ever, or a government budget. It will at some point hit some limit, and there's that trade-off within there. So when people talk about, for example, can we shift money out of bonds into infrastructure? People might, in sort of a partial equilibrium world, say, oh, look, there's enormous benefits from that. But within a general equilibrium model, there's no such thing as a free lunch, and money has come from somewhere else, and it tracks how things move around. And it's very sort of valuable in that sense. So that's in contrast to, say, a partial equilibrium model, which would, regress one variable against another, and it would look at sort of what's the relationship between the two of them. Right. And when it comes to sort of micro-founded macro models, I mean, there you are using things like representative agents, where you will say, so within an economy consists of a government, it consists of a representative household, and it consists of a representative firm, and we assume that they behave in a particular way. And then we have other countries which have their own government, their own household, their own firm. You assume they behave in a particular way, and then you observe sort of what the outcome is when you hit that model with a particular shock. So that's broadly the idea here between those two of them, if that makes sense.
Yeah, it does. So the regression model that you talked about, is that, it's been a long time since I did macro, but is that kind of like vector auto regression models? So where you're using all these lags of things like GDP and that sort of stuff?
Yeah, exactly. Yeah.
Okay.
Yeah. So that's a sort of partial equilibrium sort of analysis. Yeah.
Okay. And so what is then the debate between the VAR models approach, the DSGE approach, and the micro-founded macro approach?
So the debate, and it's a really hard one to ever solve, which I think is why it's been going on for sort of quite a while.
Right.
The debate is essentially that a big DSG model is a black box. And within that box, it's driven primarily by assumptions which are being made by whoever designed that model. And so essentially it's a calibrated model where you would make so if you, for example, a household, how much do they look forwards versus backwards? So do they anticipate events that are coming, or are they completely blind and just rely on historical data? That's a big assumption that changes the way a model will work, and will change the outcomes that you get. In particular, as a practical example, if you have people want to know whether or not cutting the government deficit is a good idea or not. Well, if you have households that are only backwards looking, it's a great idea to cut deficits because it's all good. Whereas if they're forward looking, they'll take into account that they're about to lose money and then they will adjust today. So you get really different results depending on that. And that's the main criticism of DSG models and general equilibrium models, which then leads people to then say, well, why don't we look at, instead of that, using partial equilibrium models instead? An example I would use is recently we did analysis on China's trade restrictions on Australia and what that impact was going to be. And we, for various reasons, used a partial equilibrium model for that. And it said, well, here's all these sectors in Australia who get this much money from China. If you cut some of that off, here's the impact on those sectors. Now, the criticism that we get for that is that, well, hang on, what about the fact that you can find other countries to sell this stuff to? So there's alternative buyers out there. Or what about the fact that the exchange rate would drop and make your exports cheaper? What about if people do lose jobs, they then find other jobs? So there's not actually any unemployment if they manage to find another job and if capital redeploys and so on. So the criticism of partial equilibrium models, it doesn't take in any of that into account. Whereas general equilibrium models will take those things into account. But then again, you're hit with that accusation that it becomes a black box. So I think the middle ground is probably that you have a general equilibrium framework, but you have as much of it as possible, which is based on estimation. So you actually estimate the relationships within that model rather than simply putting in your best guess and putting in sort of calibration. So I think that's probably where we end up, but there is this just debate between the two at the moment. And at the end of the day, it's like any model. If the model is really simple, you'll get criticized because that couldn't possibly be accurate because the world is really complex. And if the model is really complex, you get criticized because, oh, it's too complicated, I don't understand it. Right. You're always stuck between those 2 points, I think.
Okay, and so where does the micro-founded macro fit in there? So these formal models, is that just a whole other kind of school of thought where they're not really interested in real world data? They're just doing formal modeling, or have I mischaracterized them there?
No, I think that's part of that middle ground, that you will see sort of more models using those representative agents, and you will try and estimate what it is, how these agents behave under different circumstances. And then you sort of feed that in. So I think it's somewhere in between the two in terms of that sort of divide between really simple, well, not necessarily simple, but partial equilibrium models and those general equilibrium frameworks. I think it's somewhere in between those two spots. But the debate, I think, will keep sort of bouncing around. But there's a lot of passion on either side of the which is fun.
Okay. One question I have in relation to these models and the debates in macro is that macroeconomics obviously took a very big hit to its reputation in the wake of the GFC, because there were all these claims that macroeconomics hadn't really predicted the GFC, but then perhaps even more incisively than that, I guess, the central bankers and macroeconomic policymakers and stuff really went back to old models when the GFC broke out, because the new models didn't really illuminate what policy options you had. Have I characterize that truthfully, and what kind of reforms has macroeconomics made to itself since that time?
Yeah, no, I think that's right. At the end of the day, macro models, there's no such thing as a crisis in a macro model. So you certainly don't get sort of currency crises or banking crises or any other type of financial crisis within a model. And that's because your agents within the model, the assumptions you're applying, they don't actually have those really sharp responses to things. So you don't have a sudden sharp loss of confidence, for example. Usually when we model these things into these macro models, we model them in as an exogenous shock. So we actually imagine if there was a big decrease in consumer confidence or investor confidence, what happens from that. Most models will assume that agents are perfectly rational, that they have some forward-looking ability, some backward-looking ability. They can see where they've been, they can see where they're going. So you don't get those sharp herding effects and things like that. So really after the GFC, I think that's when we started seeing a lot more of a recognition around these sorts of herding effects, a much bigger recognition around the financial sector, which to a large extent was never really incorporated in a lot of these macro models. They didn't have money in the model. They didn't have bonds and financial assets. So I think one of the big things we've seen change is modeling more of that financial side, but also allowing for some of that irrationality to build up and those herding effects as well, which is very hard to put in. But I think that's the major change that's sort of come out of it.
Okay, really interesting. Maybe a final question just to wrap up. I was reading a interview between Noah Smith, who's a Bloomberg columnist but has a PhD in macro, and Emi Nakamura, who's sort of a very high-profile young macroeconomist from Berkeley. And one thing that stood out to me from that interview was that Nakamura was saying that one thing she's trying to do more of nowadays is to test macroeconomic theories using microeconomic data, which seems like an enormous lift. Like just the sheer quantity of data that you would need in order to do that seems very high, but you can test quite a lot of things about like pass-through and that sort of stuff. I wonder whether you think this is like a good idea. How feasible is it? Is this like a bright frontier in macroeconomic research?
Yeah, I think it's a good idea. And I think we should certainly, when we do have macro models, that we should be testing those both on sort of past events and past crises, and then testing them as well on events that occur today and seeing how well they stack up. Because a lot of the time we tend to sort of calibrate models to the past so that they line up nicely with what's happened, but we don't necessarily do the testing and the revision of those models as we go. But yeah, I think that is probably the way. I think we'll see more of that. It is a question just around feasibility and the extent to which you can actually capture all of that information and do a robust test in that sense. I mean, in many ways, we're going back to the beginning, where the reason that we produce these big general equilibrium models is that we recognize that everything is bouncing off each other, and that the economy is a closed system where everything is related to everything else. So in that sense, I sort of feel like we're going around in a bit of a circle, but I think any more testing that we can do to validate these models is going to be a good thing. And I think there is a lack of accountability on a lot of these big models that gets used. And yeah, we certainly want some more transparency in how these models work, and yeah, more accountability on how effective they've been.
Okay, great stuff. Well, thanks very much for your time, Adam. That was super interesting. Really glad that we got the Ukraine content in at the start as well. Thanks for coming on the show.
Thanks very much. There's no shortage of crises to focus on. So yeah, it's a rich day for economists at least.
Apodstomology.
If you enjoyed today's discussion, do check out Apodstomology's page at your favorite podcast directory for more episodes on topics as diverse as tax policy and the meaning of life.